Thank you all for joining us. My name is Peter Nadu, and I'm a partner and senior consultant at FIA. Today, we'll be exploring another set of topics that plan sponsors are requesting additional information on. Specifically, we'll be discussing extensions, deadlines, and other anticipated guidance. Now, backed by popular demand, we're joined today by Tim Brown and Dominic DeMattis from Thompson Hine. We can start with a question for Dominic. Now, Dominic, how does the extension of the April 15th tax return deadline affect employee benefit plans?
Thanks, Peter. The general effective date, or the general change in the tax deadline to July 15th from April 15th affects actually only a couple issues related to employee benefit plans directly. First, there's a period during which an employer can make discretionary contributions to, say, a profit-sharing plan and still receive a tax deduction for the prior year, in this case, 2019. The deadline for that generally is the tax return due date. Generally, it's April 15th. In this case, that has been extended to July 15th. Other changes based on the change in the tax deadline really affect individual contributions to things like health savings accounts and individual retirement accounts. Those deadlines have also been extended to July 15th.
Great. Can you explain to the listeners maybe a bit more about what changes to benefit plan deadlines were made by the CARES Act?
Yeah, sure. So there are a couple important changes in the CARES Act related to this issue, actually, of the change in the tax deadline, because one of the significant expenses that a lot of employers have, to the extent that they sponsor defined benefit plans, is their minimum funding contributions. Now, that was not changed because of the change in the general tax deadline, but the CARES Act did delay all minimum funding required contributions, including quarterly contributions, until January 1st of 2021. There also were some changes similar to deadlines, but required distributions that come out of plans, minimum required distributions. There's some changes to that in the CARES Act as well, in that required minimum distributions are no longer required to be taken with respect to the 2020 year.
That's helpful. So what other extensions to deadlines related to benefit plans has the IRS offered?
So now the IRS has followed up both that, tax deadline change or extension, if you will, and the CARES Act with a long laundry list of delays. And the general rule for these delays is that pretty much anything that's on the list of delayed items that would have happened or would have been required to have been done or paid between April 1st and July 15th has now been extended or changed until a July 15th deadline. So, for example, if you have a plan where the annual report, the Form 5500, is due anytime between April 1st and July 15th, the new deadline for that is now July 15th. Plan loans, there's some issues with plan loans and plan loan repayments, and this is not to be confused with the changes that the CARES Act made to plan loans. This is a general change to plan loans. If a plan wants to you make use of this change, the loan repayments that are due from a participant between April 1st and July 15th are now all due on July 15th. The requirement to kick out excess deferrals, essentially when someone has put in too much money under, say, a 401k plan under Section 402G, the general deadline for that is April 15th, yesterday. But if that wasn't done, it's okay because that deadline has been extended to July 15th. There are also changes to other similar types of deadlines, like an ability of someone to make an eligible rollover distribution within, say, the 60-day period. That the 60-day period, if it were to end between April 1st and July 15th, has been extended. The correction period for self-correction of certain operational failures that might be available under EPCRS, if you're running into a deadline with that, that's been extended. There are some changes and extensions related to ESOP distributions, 83B elections, and also some deadlines related to cafeteria plans. Again, all extended to July 15th.
Interesting. Now, one of the extensions you mentioned involves repayment of plan loans. If that provision is required, can you explain how that may differ from a delay in loan repayment? And from a practical sense, how would the extension of the due date work?
Yeah, no problem. The plan loan extension is a little bit confusing. I mean, as an initial matter, the way that the deadline extension was granted, again, it says from the IRS guidance that any loan repayment that's due between April 1st and July 15th is now due on July 15th. One might read that and say, boy, am I required to do that? Does that mean I have to, change all of my administration and make sure that I do that? And, I think we believe the answer to that is no, it's not required. It's an optional feature that a plan can make use of. And it's a feature that you may want to make use of in a certain situation, depending on, the situation that your participants may find themselves in. It may be very useful, obviously, to somebody to not have to worry about, say, a loan defaulting during this period of time, if you can use it. And one thing that's important about this is that this extension of loan repayments from between April 1st to July 15th, with all of those payments in that period being due now on July 15th, that applies to anyone. The CARES Act change that allowed some, forbearance with respect to loan repayments applies only to certain individuals, affected individuals. And Tim, I think, is going to talk a little while about some questions regarding implementation of that change. But this one that I'm talking about, the extension between April 1st to July 15th of all of these loan repayments, applies to anyone, again, if a plan chooses to use it.
Fantastic. Thanks, Dominic. Now, turning to Tim, there are many questions regarding how the new CARES Act distribution and loan provisions could be the subject of future guidance, such as what options are available for plan sponsors as they decide what changes, if any, to make to their plans in response to the CARES Act, and how certain provisions can be implemented. Tim, can you speak to these questions a bit?
Yeah, thanks, Peter. Would like to. I think there's many unknown questions that have been asked regarding the CARES Act impact on 401k plans. And in particular, just as a reminder, there are three key features of the CARES Act that impact the 401k plans now due to the coronavirus epidemic. One is the provision that would allow plans to be amended to permit distributions of up to $100,000, loans up to $100,000 or 100% of the account balance, and the delay in repayment of any existing or future loans. The fourth item there is suspension of minimum required distributions, which is something that all plans will probably be implementing, but I want to focus on the first three CARES Act options here. But the big thing is must a 401k plan, or the big questions that come out are the following. Must a 401k plan adopt all or only certain changes? Is there flexibility in this? Well, the key is no. Plans do not have to adopt any of the CARES Act options. They can adopt one or two or all three of them. And there is flexibility in some of the options, such as they could not allow the whole $100,000 withdrawal options or the whole $100,000 loan. They can make it a lower amount, or they can limit the dollars to those in a particular source, like a 401k deferral. However, a lot of the plan administrators are not prepared to do that at this point in time. In order to offer these options as quick as possible, it's a one size fits all. So most plan record keepers, whether you're dealing with T. Rowe Price, Fidelity, Vanguard, Schwab, or whoever else, are just going with the whole maximum limits at this point in time, with potentially the option to do something different down the road. Another common question is, when does a plan have to be amended, and how best to document your CARES Act decisions? Well, plans don't legally have to be amended for these provisions until 2022, which is a good thing, because we would be expecting guidance from the IRS maybe over the next several months, if not the next year, on how to interpret and implement these changes. So you're best to wait to do any kind of a plan amendment. However, it's a best practice to clearly document what your decisions are now, so when it comes the time to do amendments, it's clear what you have elected and when you elected it. Because remember, these options are only available for a short window period, which I'll get into the next one. Are there any deadlines for adopting any of these CARES Act? And the answer is really not, but practically speaking, the loan, any suspension of loan payments, the suspension is only good to 12/31/20, so you've got just the rest of this year. If you want to allow loans up to $100,000, those are only permitted until September 23rd. If you want to allow $100,000 withdrawals, those are good up until the end of this year, 12/31/20. So the sooner you put them in, the better your participants may be, but you could wait and put these in at any time before the window closes. But then again, your participants won't have much time to use them once you put them in. but these are definitely windows, so they're all gone. All the options are pretty much gone as of the end of this year. Okay. Now, the other common question is, how do these provisions apply to participants who have terminated? Well, typically, terminated participants will not be able to get loans. So, however, terminated participants might have loan repayments that could be suspended, so that option could be beneficial to them if they're continuing to make loan payments after termination back to their 401k provider. And also, they still have the option to take the $100,000 withdrawal at that point and get the favorable tax treatment from that withdrawal in the right to repay. So that's a key thing for terminated participants. Another common question would be, must all loans be suspended? And the answer is no, only those that are eligible to be suspended and those participants who have elected it. So if the plan sponsor did elect the CARES Act option of allowing loan repayment delays, then the participant can come in and make that election, assuming they're eligible for that election, meaning I call it they're COVID-19 eligible. You've got to meet the requirements to be of the CARES Act in order to make those elections. Okay. Another interesting question that comes out, what are the terms of the $100,000 withdrawal repayment? Well, there's a lot of details there that we're going to have to wait for IRS guidance. But essentially, you could pay the tax over 3 years. Many 401k record keepers are withholding 10% right away. And you have a right to repay that amount within 3 years, and there's no 10% early penalty. Now, the terms of repayment, how you're supposed to make that repayment back to the current plan you took it out of, or future plan or IRA, that's still going to be open for IRS guidance at this point. Another question is how long can loans be suspended and how are they repaid? Well, the statute, the CARES Act statute says you have up to 1 year from the date of the loan payment. But many record keepers are really imposing a more simplistic rule of saying any loans that payments are being suspended now, they're going to restart them at the beginning of next year in 2021, re-amortize the whole loan, and then extend that loan over the same period of the suspension. So every record keeper is going to approach this a little bit differently because the statute is not clear on how that's supposed to occur with respect to the end dates of the repayments and how the loan gets re-amortized and extended. Again, we're going to have to wait on guidance. But right now, some record keepers are just delaying the payments until January of 2021. Okay, but more information to come. Another interesting question is, under the CARES Act, are you eligible if your spouse loses his or her job or is on furlough? And the answer is right now, no. However, we would expect IRS guidance to potentially cover that. Because understanding that in order to be eligible for these CARES Act options, you have to be diagnosed with COVID-19, have a family member diagnosed with it, or you, the participant employee, has to have a financial impact due to layoff, furlough, reduction of hours, or in quarantine. It does not refer to the spouse, but we think that the IRS could extend that guidance to include the spouse. At this point, as we know, there are 2 wage earner families and they need both wages to meet their current obligations. And if one loses their job, that could be a financial distress situation. Okay? So those are some of the common questions, and I went through them fairly quickly with regard to the CARES Act. But another popular question that has come up related to the CARES Act and the economic situation we're in now is, can a company reduce or eliminate a match? And the answer is yes. And if you go to one of our prior recordings, we go through some of the issues on reducing and eliminating match. And in most cases, the company can do that prospectively, but there's a lot of issues to be addressed and looked at. But I refer you back to another previous recording that we did. Peter, you want to take it back?
Sure. Thanks, Tim. So that was a ton of information, all incredibly helpful, and certainly appreciate it. So Tim, Dominic, once again, we thank you for joining us during these uncertain times and providing such great insight. For all those listening, please feel free to reach out with any questions you may have pertaining to these or any other topics related to your plans. Again, thank you for listening and stay safe.